Hello traders, Gary Wagner here, just about 12 noon in Honolulu, 6 o'clock in New York. It is Friday. Happy Aloha Friday, as we say on the islands, September 22nd, 2017, and this is the Daily Report for Gold and Silver, our weekend review, and what a week we have seen with the second week of downside pressure in the precious metals markets. Gold moving down tremendously below 1,300, but then recovering today as it closed up about $5.70, closing at 1,350 cents per ounce. Silver, very tepid move, up about 1 cent at 17.03, and that in light of a fractionally lower US dollar, which trades still below 92 at 91.96. Traders, although gold is trading up today, up roughly $5 on the day and trading back to 1,300 per ounce, to say that the last couple of weeks have been tough weeks for gold bulls would be an understatement. Now, for the second week in a row, when we look at a weekly chart, we can clearly see that gold has in fact closed lower on the week. This week, for example, we can see that it traded to a high above 1320. It traded to a low of around 1290 and is currently trading up 5 at 1300. This following last week's decline, in which the market in essence moved from 1340 to close just above 1320. However, even within the recent sell-off, when we look at our basic bullish model, that model is absolutely still intact. And traders, the best way to illustrate my point about still being in a bullish model is to look at a daily chart that contains both Fibonacci retracement as well as our current Elliott wave count. Now, in terms of our Elliott wave count, we begin on July 10th as the market had bottomed and hit a low just around $1,200. We had a first rally which went from 1,200 to 1,280. That is being labeled as our wave 1 in terms of an Elliott wave count. The correction that followed was roughly a 23% correction, taking the market back to 1,260. From 1,260, we had another dynamic rally, roughly $100+ rally, going from 1,256 up to 1,263, and that would have been our wave 3. Now, the interesting thing about this third wave is that when we do a fib extension, which I do not have up on the screen, of wave 1, wave 3 is exactly a 1.618 extension of wave 1. That falls within a textbook case for this third wave up, and that of course has been followed by the current correction that has been existent in the market over the last couple of weeks, in which we have seen the market sell off pretty strongly from these highs at 1363 down to its current pricing at 1300. Now, the reason I say that the bullish model is still intact, and we can see that on a technical basis, is first off, this most recent retracement has given back 61.8% of the most recent rally. Secondly, when we take a look at this most recent rally and we look at the price point here at 1,300, we can clearly see a level of what was formerly a resistance as the market came up against 1,300 on multiple occasions and would stall. Then we talked about the fact that we had what's called a scouting party. It attempts to speak to the fact that as you hit different points of strong resistance or strong support as the market is moving up, the bulls will test the fortitude of the bears by moving the price point into that ground before tracking lower, and that is simply called a scouting party. When it effectively closes above that price point, it is called a beachhead. So we certainly saw that happen. The market went up, and we can say that this area of 1,300 is a clear and decisive important area that was formerly resistance, and now I believe it to be support. Therefore, it is my belief that if we see follow-through buying at the beginning of next week, this long and defined correction as the market went from 1360 down to 1300 will in fact have concluded. We will be looking at a scenario in which we had our wave 1, wave 2, our wave 3. Our wave 4 is now concluded, and we can begin to calculate the upside potential of this next rally, which should be roughly equal to that of wave 1, which was $80, which would take the next leg of this rally roughly to 1380, matching the record high of last year. My recommendation is that we will stay flat through the weekend and look to initiate a long position in gold, assuming that we have follow-through buying from today's upside move. Traders, we certainly did have a tough week, and we certainly did take some losses. We attempted to get in as the market was trading lower and went to logical Fibonacci retracement points. However, those points were not the conclusion of the current correction. The fault lies with my analysis, and I take full responsibility for that. However, at the same time, I believe that now that we have hit the 61.8% retracement point and bounced up, and especially given recent threats levied by North Korea, we could certainly see this market take off and move to the upside next week. We do have a new updated upside target, as we spoke about during the technical study section, which would take us to about 1380 once this next rally gets underway through its conclusion. This has been Gary Wagner, wishing you as always good trading. We will talk to you next week for another daily update and review. Bye-bye.